Welcome everyone, and clearly this is a very volatile time. So I thought it would be a good opportunity to do a live stream again. I had one last week, and obviously the announcement we've just had completely upended markets, which is that Trump has announced a 90-day pause on reciprocal tariffs against non-retaliating countries. So as a result of that, we've seen equity markets go crazy. The Nasdaq, for example, is up, oh gosh, a lot. See if I've got intraday data here. Well, I think I can find it. Yeah, so huge rally in equity markets. I have got a number, 1 second. So if we look at the Nasdaq, it's up about 8.7%. If you look at the QQQ and ETF, the All Country World Index probably will be up tomorrow, and because America is such a large component of it, MicroStrategy up 22%, Tesla up 17%, Nvidia up 15%. So a huge risk rally and a reversal of the big sell-off that we had as well. So clearly, this kind of policy making has completely shattered markets. It's completely undermined, I think, the idea that markets, or at least governments, can be trusted to not completely first tank and then pump up their own markets. So really all you can say, I think, is that if you look at the Treasury market, certainly the fact that Treasuries were selling off was particularly worrying. And I wonder if that was behind what happened today. Plus, obviously, there's been a huge amount of pushback from so many Americans because if you just look at the popularity polls for Trump since markets have tanked and pensions have collapsed in the US, you can see the effect of the equity market sell-off. So I think this is just a way for Trump to say, look, all of these countries have contacted us, saying 75 countries have called representatives of the United States to negotiate a solution. And these countries, at my strong suggestion, have not retaliated in any way, shape or form against the United States. So I think that's really what's behind this 90-day pause and a reduction of this reciprocal tariff effective immediately. So this is Trump backing off. I think he's seen that this is going to crash the economy and it's an absolute catastrophe. So let's just hope that this has shown them that you can't do a Liz Truss and, put a finger up to markets and say you don't care. Hopefully this will also stop them doing the crazy stuff like the century bonds, where countries will be invited to swap their coupon paying treasuries for century bonds which have no coupon at all. Now, if it's voluntary, it's not a default, but it's a default in anything but name. So I think hopefully this is going to make the crazy stuff less likely to happen in future. And I wouldn't misread this. I think it is Trump backing down on the tariffs, which is a good thing for everyone, including the United States. So I will be answering questions tonight. There was one question at the previous live stream which I didn't answer, which was from David Walsh, which in retrospect actually looks kind of irrelevant, where he said, is this not a great opportunity, a buy opportunity, if you believe in the long-term benefits of AI? And of course it is. If you do buy equities, then when they're at a depressed price, as long as the company itself is sound, yeah, sure, that increases your long-term return. And in fact, I just did a member video today for our website members, which was talking about a market crash shopping list, where I was talking about the kind of things which I'd consider buying when you get a big market dislocation like this, simply to reframe the crash so that you're not so scared of it. So you're actually thinking, well, actually, this is the bargain, which is the right way to think about these sell-offs. Of course, if you're in retirement and you're drawing on your savings, it's a very different story. There you don't want to draw on the things which have crashed. You just draw on the safe stuff. But in retrospect, David Walsh, yeah, I think, but even at the time, I think I would have said, yeah, if you believe in AI or any particular equity theme, then as long as your thesis is sound, yeah, you're better off buying at a depressed price, and it is an opportunity. So I think that's exactly the right mindset, David Walsh. And if you are listening, apologies for not doing your question last time. So let's have a look at what's going on for your questions. Don't forget, if you do a question, a super chat, you'll be pushed to the front of the queue. If you're one of our supporters on YouTube, also you'll be pushed to the front of the queue for your question, and it'll pop up in this document, which I can see next to me, and hopefully I'll get to actually read your question this time. I'm sorry about that. So we did record a podcast called The Orange Swan, Surviving the $10 Trillion Sell-Off. So that was our latest podcast. Many Happy Returns is the name of the podcast. Do subscribe. And we've had, I think, 1.2 million downloads now. So we've been going for a while. We've got lots of episodes under our belt. I think we've got it down pat now, Michael and I. So do have a listen to that. And in that we're talking about this big sell-off. And of course, the size of it. And what the Fed put was our dumb question of the week. So do have a listen to that. Do subscribe to that. Yep, and that's the document I'm not supposed to show you, which has the comments from Laura. She says she doesn't put things in there now because she knows I'd show it by mistake. There we go. That's professionalism for you. But look, a celebratory orange drink. Right, so we'll be together for the next 53 minutes. If you have any questions, please do fire away. So what have we got? So no super chats yet. Please do. Rob C says, I bet he's busy rewriting this as we speak. I don't write much usually. Sometimes I have a couple of slides just to kind of prime the pump and just to show you really. Oh, we've had a super chat. Looks like Amir Ketobchi. I think I recognise his image. Very good. Thank you, Amir. And your questions. You might need to do a podcast all about insider trading. That's from 94070. Is that a zip code? Anyway, that's an interesting comment, because you can imagine if people knew this was going to happen, you could also know that markets were going to tear upwards. So I think the SEC, if it was still effective, and I'm not sure it still is, would be looking into insider trading if they did see some big trades put on just before this happened. But look, in this kind of environment, I doubt the SEC even cares now. Andrew Dobson, long-term investment, fine if you made a short-term investment. If you made a short-term investment, you might want to look at your budgets and make some changes. I think the problem, right, if we do get a big rally, which we are getting right now, is you just don't know what's going to happen. Is there going to be another comment on his Truth Social platform which says, no, actually today I feel like I'm going to reimpose the sanctions? I think there was a nice quote from Katie Martin. Let me just show you. I just think this was great. She's the markets editor, I think, for the Financial Times. She also does the Unhedged podcast, which is very good. Here we go. Here we go. I just love this. I don't know if you can see that. Make it a bit bigger. As I keep saying, you can't put the back in the donkey. Even if he scraps all the tariffs tomorrow, the damage is done. And I think that's true. I think that people just don't trust the United States anymore. And it's not just about tariffs. It's about defense. It's about trade agreements. You just can't trust the US. That's the kind of end game here. And people are not going to forget that for a long time. The fact that the Treasury market was selling off perhaps was the coffin and the nail of the tariffs, but at least the broad-based tariffs. Now, hopefully, they're going to have something more sane and more targeted. But I just thought that was a great quote from her. She's very funny. Right. S&P is doing better tonight. It certainly is. The compounding investor. Do most government bonds follow suit if US Treasuries are dumped by investors? Yeah. So let's have a look at the UK gilt market, just so you can see this. I was looking at it earlier. It's shocking. So what I'll do is I'll sort the UK government bond market by maturity. So that's what you can see on the left-hand side here. And so this is the 2073 bond, TR73. This is the longest duration UK gilt. So let's zoom in on that. This is its price over the course of, let's do 2 weeks, just so you get a feel for the volatility. So this is what it was doing up until April the 4th. Then when US Treasury started to sell off, notice how this one sold off too. So if we add the TLT fund, so this is the US really 20-year plus ETF, and it's an ETF, so all instruments, I'll get there, yeah, NASDAQ TLT. So this is the iShares 20-year plus Treasury ETF, just for comparison, so you can see. You can see that TLT was going up in price, same time as TR73, the UK gilt in black. And then when TLT started to sell off, so did TR73. In fact, if you zoom in, notice the high correlation here between the two. So it's pretty clear that US Treasuries drive the UK market very strongly. There is a very high correlation here. Now, is that because of a problem in the UK? No, it's because people lost faith in the US Treasuries briefly. But hopefully that's been restored now. But it was the case that yields were spiking in the UK very dramatically, and that had the Bank of England worried. I mean, people were talking about hedge fund liquidations. Let me just move this. You can't see that at all, can you? So this is what I'm talking about, this very high correlation period here. The blue line is the TLT fund in the US, the TLT ETF. The black line is TR73, a UK gilt, very long duration gilt. And if we scoot through some other bonds, you can see it was a very similar story. All of them are selling off at the same time as TLT. If we go to shorter duration, if we go for the 10-year bond, so something like, what would that be, 35? So let's go for TR30, no, it's index linked, this one. Again, very sharp sell-off in that as well. Obviously not as much because the duration's much shorter. So yeah, pretty clear that it's the UK market that was selling off as well, which is shocking. And it was just being dragged by the US. That was the source of the volatility. So yeah, good old bonds, eh? They did the job. That's great. Treasury basis trades. Let's see if there is a super chat here. I think Amir gave one. Yes. Amir Ketobji has a super chat, and he says, "Hi Roman, I bought some Vanguard funds this afternoon before his tweet and the hike. Does that mean I bought before the rise, or are index funds bought all together in the evening and I missed it?" If it's Vanguard, it might be delayed by a day, unfortunately. You can trade on an intraday price if it's an ETF with Vanguard, but it sounds like you didn't do that. So I suspect it's going to take a couple of days to clear. So I suspect you're going to buy at a higher price. But look, even if it rises by 9%, I don't think that's going to take us back to where we were. You might still be buying at a discount. Let's zoom in. Just see the size of the sell-off. And I'll get rid of TLT. Yeah, because it was chunky, wasn't it? So let's look at 1 month. And we'll look at SPY, which is the S&P. And it's down, it was down about 12.6%. Now it's down about 6. So you're still buying at a discount relative to where we were. So I wouldn't worry too much about it. You can never time these things perfectly. That's what the graph looks like. So since the 26th, let's zoom out a bit. Yeah, so since the peak, which was, when was that? February the 19th this year, it's down by about 13%. So you've still bought at a discount. You know, that's the good news. And remember, a global index will be 65% composed of this S&P index. So that's reassuring, I guess. Nobody's going to perfectly select the bottom of the market. And who knows, you know, maybe risk assets will still have a little bit of a risk premium priced into them, which wouldn't be surprising, right? Because we're always still worried about future tariffs, because now we know how bad the effects are and also how bad they are on risk markets. So I think you've missed maybe 10% upside. But look, presumably, Amir, you were buying for the long term anyway, so it's not going to be so painful after all. In fact, I just started my drip feed in my SIP out of cash and into equity, global equity. And I think that did go in before this big jump upwards. But it's going to be a volatile period, no question. The next question is from Simon Jones, who says, I remember you recently mentioned that you were considering moving your core holding of VHVG into ACWI. And I can't see the rest of it. Let's see if I can find the rest of the question. I can't see the question. Alex Jones. Simon Jones. Yeah, okay, so I did move VHVG into ACWI. Now, why did I do that? Well, the reason why I bought VHVG was that it was the cheapest fund, which was semi-global. It was developed only. It's a FTSE developed index tracker, so it excludes emerging markets, which are 10% of global markets. The reason why I chose that was because it was the cheapest one on Vanguard. When I moved my SIP away from Vanguard onto InvestEngine, I had a much wider choice of funds to choose from. So I could choose a cheaper, truly global fund, which was 0.12%. So it's the same fee as VHVG, but it's global. Because ACWI, All Country World Index, includes emerging markets that are extra 10%. So that's the one I've chosen on InvestEngine as my global equity fund, my single fund, if you like. And I will be dripping into that over the next 12 months. And yeah, I'm glad I started the drip feed when I did. So at least a 12th of it was bought at a low price. But that's why I did it. That's the plan. So that's what I'll be using on that platform. And I've still got some money left on Vanguard, so I'll probably use VHVG on there. Because I had to leave some of my SIP on Vanguard because I wanted to keep that account open so I can put business contributions into my SIP. I can do that on Vanguard, but I can't do it on InvestEngine yet. So that's why I kept it open. So yeah, there we go. Next question. If you have any super chats, please do super chat. I'd appreciate it. Right. So Laura's actually not here. She's gone on. She's gone and done some kind of. She's gone on a kind of. I don't know what you call it. Spa. I suppose it's a kind of spa. But she's very kindly agreed to do this live stream, even though she's supposedly on holiday, supposedly relaxing. So thank you, Laura. I appreciate it. She's a star. What's the other question? Here we go. Alex M says Treasury basis trades. What's going on? Risk of systemic instability, sky high interest rates and a mountain of debt. Right, so using the gift of my hands, I shall demonstrate the basis trade. So let's say we're thinking about arbitrage. What is arbitrage? The idea behind arbitrage is, let's say you've got two versions of the same thing. In other words, economically the same instrument, but it's wrapped up in different ways. Now, there are two ways of buying treasuries. One is to just buy a treasury physically. You buy the bond, you pay 100, it sits in your brokerage account. Or you can buy a future, a treasury future, which is an agreement to buy a treasury at a fixed date in time in the future at a fixed price. So that's called a treasury futures contract. Now, both of them give you exposure to the on-the-run treasury, whatever maturity you've chosen. Let's say it's a 10-year, that's the most liquid one. So let's say you bought a 10-year treasury, physical, or you buy a 10-year treasury future. Now, both of them give you exposure to the same thing. So in theory, after you've applied some multipliers, they should have the same price. But what if there's a discrepancy between the two? Well, then, in a month's time, say, you can deliver your treasury, but lock in a risk-free profit at that point in time. Now, that's called an arbitrage trade. But the difference between the treasury itself and the futures contract on the treasury will be absolutely tiny, some fraction of a percent, unless there's a huge market dislocation. So that means that in order to make a reasonable profit with it, you have to have a huge amount of leverage. You borrow money to put this trade on. So you've got $1 million, say, you borrow 3 million to buy even more of those two contracts, so that you make even more profit. Now, assuming that the profit happens, it is risk-free in a sense. So you're just levering up a sure bet. But what happens if you get margin called, or if there's a huge disruption in markets, which means that the basis blows out? Well, that's a problem, because then the hedge fund has to unwind the trade. And that means, because they have to post collateral, they have to sell stuff to close the trade. What do they sell? Well, they probably sell treasuries. So what happens then is you get this kind of dislocation in treasury markets, which is amplified by hedge funds unlevering their basis trade. And you get this kind of downward spiral, which is really painful. And it's interesting, if you read the Fed's financial stability report, they were talking about pockets of leverage throughout the US. Households in the US, not very leveraged. Companies, not very leveraged. Hedge funds, very leveraged going into this big sell-off. So that was clearly a problem. Clearly, a lot of these hedge funds did get margin called due to this huge move in treasury yields. And that was a problem for the market. There was dislocation, there was disorderly trading in the treasury market, which gets the Fed really worried. And I think the Fed was probably with its finger hovering over the red button, ready to step in. But as it turned out, Trump made his announcement. So yeah, everything was eventually okay. But that's the kind of gist of the basis trade. I love arbitrage. I love arbitrage, the concept of it. It's really interesting. Gary James says the dead cat got kicked down the road. Very good. Teddy doesn't like cats. He's heard the word. He's back in the office now. Did I say cat? Did I say cat? You don't. Oh, he's gone to look for the cat now. You can find the cat. He's in the garden. Oh, that's cruel. Next question. Let's see if we have any super chats. Next question is from Yusuf, who says, the compounding investor, if there's no agreement at the table in 90 days, this will end bad. But until then, markets can pump and swing. From now on, every news can be dangerous, even the small ones. Yeah, you're just terrified of what Trump's going to do next. I think that's the fear. You don't forget that. And I don't think things will go back to normal. I think markets are going to be very jumpy. Mike Alloway says you need to do live streams to keep up because Trump keeps changing his mind every 2 minutes. That's so true. It's a casino. Matthew Mills. Hedge Fund says hi Roman. Hello. Trump trade, gotta love it. That's K Roddy. It's good to see you on top of things, even if you need to do these streams to be relevant. You need to do these streams to be relevant. Yeah. It's kind of true because when you make a video on YouTube, if you want to know how the sausage is made, the way we set up our system is there's quite a lag between the time we make the video and the time it's published. So in a sense, you can't do anything topical. So that's why the live streams are a really useful way of doing these kind of topical things. But I can react immediately. That's the nice thing about it. Ned Flanders says, my girlfriend calls you the third wheel to our relationship. Well, I don't want to come between you, Ned, but that's nice to know. Yusuf said it slowed down a bit. Mucho Mate says the bonds have not recovered at all. Now that is worrying if it's true. I haven't actually got live pricing for, let's see if we've got TLT live pricing. There was a bit of a rally, I think. Not much, as you say. So let me share this. So this is for the TLT ETF. Let me try moving my face. Right. So this is the TLT ETF. And you can kind of see that it has rallied a bit. It's gone from 85.96 to 88.32. And I don't think we're at the US close yet, not quite. So yeah, that is pretty shocking. Not much of a recovery at all. If we zoom out a little bit, yeah, so that's the big sell-off. But I don't think this has got intraday pricing, unfortunately. And I don't think I've got access to US Treasury intraday pricing either. But that is worrying, if it's true. Thanks for telling me. RJ says Besant is a nervous wreck. That's a Treasury Secretary. SR says evening Roman. Hello SR. Josh Beery says straight up market manipulation. Look, I think clearly if Trump makes an announcement like he did, it's going to move markets, no question. So is that market manipulation? I don't think that was deliberate. I think that was simply backing off because of the huge damage it had done to his reputation, to the Treasury market, to the equity market, when, I think at a certain point he has to listen. And it sounds like he did. Gringer Door says, caved like an orange beanbag. Lynn says, good evening, Roman, Laura and Teddy. Lovely surprise. Nice to hear from you, Lynn. Lynn always joins us for these calls. It's great. David Cattle says, do you know if the full tariffs will be applied after a 90-day pause? No, and I don't think anyone does. And I think that's the worry, right? It's just like a reprieve. It's like being on death row and then suddenly, okay, actually, you're wheeled away from the execution room, but it's still there. You know that it's there. And you've still got a date in the diary when you're going to have to go back there. So it's not really that much of a reprieve. And that's why I think markets won't go back to where they were. It's kind of like when you get a takeover of a company. if the price starts here when the companies announce just before the announcement of the takeover, and if the price after the takeover is up here, the price then oscillates between those two prices according to how likely the takeover is to happen. So if it's 100%, it goes up to the takeover price. If it's likely to fall through, it goes down to the pre-announcement price. So this is a little bit like that, where we've got the kind of pre-crazy tariff price for the Nasdaq, say, and then you've got the post crazy announcement price. And what we'll probably see is oscillation between those two, which is going to be very difficult to navigate, I think. Josh Beery says tariffs are 10%, which is still insane from an economic perspective. Anger the planet. We look like we're an unreliable business partner and degraded investor confidence. Yeah, completely agree. At least so far, the good stuff, the good news, I guess, if there is good news about this, is that the hard data, so that's GDP, inflation, unemployment, weren't affected yet. So the tariffs were taken off before the damage was visible in hard data. It was only visible in surveys so far. Business confidence, consumer confidence, which is damaging. I think people are worried. And apparently some companies had already started firing people in anticipation of weaker growth. So there has been some damage done, and I think it's true what Katie Martin said, which is you can't put the poo back in the donkey. That's the problem. See if we've got any super chats. Yes, we do. Stephen J, thank you. He's one of our supporters on YouTube. He says, he's called John Mearsheimer, said recently that Trump boycotted Congress for the tariffs and isn't upheld by checks and balances like other executives before him. He says Congress is in disarray. Yeah, and this is what worries me. Apparently, obviously the US operates on this idea of checks and balances where the different branches of government keep each other in check. Because remember, the people who set up the US, the founding fathers, had come from pretty despotic regimes in Europe where they'd been persecuted. So they wanted to set up a system where there wouldn't be a king, right? Where you couldn't have one branch of government doing crazy stuff without the others stopping them doing it. And by having three branches of government, they could keep an eye on each other. But it seems like you say that the executive, the presidential bit of the three-part governmental organisation, got too powerful. And I think there will be a pushback now. Congress will push back because ultimately Trump used emergency powers, which may turn out that he overstepped his authority in order to impose these tariffs. And certainly there'll be more support for that pushback given the economic damage that would have ensued. So maybe he backed off before that was visible, before there could really be a groundswell of support in Congress to kind of turn back what he was doing and to weaken his power. Yeah, so it is kind of a shocking weakening of that checks and balances system, which is a great one. I just wish we had something similar here in the UK, and a constitution for that matter. Philip C, super chat. Thank you very much. He says, I have a friend in New York. If you lived in America, would you invest in the S&P 500 or a global fund? It's funny because I speak to quite a few Americans, often people who work in the tech industry, who kind of talk about how to invest their money, and they're very well off. Justifiably, they're very skilled people, and often they talked about why would I ever buy non-US equity. Often they've worked for Magnificent Seven companies. They've got stock options in Facebook, Microsoft or whatever. So of course they think that their system, their stock market is supreme. But what we've seen recently is actually, once in a while, the US really screws up. And remember, if you go back and look at annual data since 1975, the US only outperforms 55% of the time. if you go year by year. And people forget that because recently the US has outperformed by so much because of the Mag 7. So I think what this has taught us and taught people in the US is, yeah, you shouldn't go for just US stocks. It isn't the best stock market in the world. That you should think about other countries. And the unthinkable has happened, which is that Europe has outperformed the US significantly over the course of this year. So, yeah, I think that if I was in the US, I'd do the same thing I'm doing now, which is to buy a global fund. And I could do it more cheaply because they've got VT, which I think is a very low fee. Global equity fund from Vanguard. VT Vanguard. Let's see what the price. I think the fee for that is 0.08%. It's the Vanguard Total World Stock ETF. This is it. And the fee is 0.06. Oh, I'm jealous. Mine is 0.12, so I have to pay twice the fee because I live in the UK. We don't have such large scale. Anyway. Back to your questions. Super chats. Thank you, Philip C. There's your answer. Yeah, I'd go global, I think. Amir Ketobchi, another super chat, says chances of a trust moment with Trump. In a sense, we've seen it because instead of being like a lettuce and being pushed out of government, he backed off. And I think, is that a trust moment? It kind of was. There are certain parallels with what Liz Truss did. For example, ignoring what the Office for Budget Responsibility said. Similarly, this regime, they ignore economic convention by having these blanket tariffs. Coming up with that bullshit equation for the actual tariffs themselves was a joke. You know, having those two Greek numbers, which one was a quarter, the other one was 4, multiply them together, you get 1, so they disappear from the equation. That was ridiculous. And just, you know, looking at the trade deficit in goods and dividing by the imports from that country. So, you know, it's such a simplistic approach to such a complex trading system for the US. You know, that was all, it just made America look ridiculous. Things like saying you're going to take over Canada. I mean, that's ridiculous. Or Greenland, you know, I mean, all of this stuff makes the US look ridiculous on the world stage. And, you know, I think this is going to backfire badly. So in a sense, this is worse than Truss, because at least with Truss, the system pushed back and she was ousted. And then they had a massive defeat in government following that, justifiably, I think. There shouldn't be any forgiveness for what they did. But what Trump has done still has support, remember. If you go to the Midwest, many people still support him because they believe that he supports Main Street rather than Wall Street. They really believe that, even though it was becoming clear that it was going to hurt people economically in those very places where they thought he was going to help. So I don't buy the statement that it was going to help people who were in manufacturing jobs in the United States, that it would bring back manufacturing to the US because of the damage that it would have caused for exports from the US. And that's, of course, the effect of counter tariffs. So, yeah. So in a sense, it was a trust moment, although slightly different and scaled up, because the UK is less relevant globally, economically, because it's so small relative to the US. But for the US to do a trust moment makes it that much worse for everyone. Yeah, it was shocking. But it's not over yet. You know, we've still got 3 years, 9 months of this to go. Who knows what's going to happen next? Oh, very brilliant question from Aristotle 1985, a super chat. Thank you, Aristotle. What if Obama had done this? You can imagine, you know, there would have been huge pushback and calls for him to be impeached. What amazes me is that there hasn't been more pushback from US companies. Fine, they wanted to get rid of diversity, equity and inclusion policies from those companies, and maybe even push their European counterparts to do the same. That they were willing to do, but no pushback to the tariffs coming from companies. Jamie Dimon, in his annual newsletter to shareholders, mentioned it. He said it would increase inflation, but it was pretty weak stuff if you read what he read, if you read what he wrote. It is very spineless, I think, of US companies not to have said more, because they knew what the effects would be. They were at the front line. They'd probably seen the effect of the tariffs previously in some sectors like aluminium. So why didn't they stand up to this? But I don't understand that. But if Obama had done it, I think there would have been uproar. But with Trump, he will go for individuals, and there will be repercussions for individuals if they go against him. Whereas I think with Obama, he would have had the courtesy not to do that, not to target individuals, whereas Trump, of course, does via social media. So maybe that's why nobody's stuck their head above the parapet, as it were. But it's shocking, I think. Right. Josh Beery says tariffs are 10%, which is still insane from an economic perspective. Angered the planet. We look like we're an unreliable business partner to great investor confidence. Yes. There will still be a battle when he reflects on this and can't reconcile how badly he's humiliated himself. Yeah. What I'm really looking forward to is the narrative. Will the US papers say he backed off? He'll deny it, but this was inevitable, I think. Electronite says, is this inside trading? Look, I worked with someone in the UK who was a copper for the Financial Conduct Authority, as it was named something differently previously, but this is the kind of thing they look for. So what they look for is very large positions being put on directional trades just before the announcement, and they'd investigate them. You know, literally, they'd go to each person and they say, look, you put this trade on, and then they'd investigate whether there was inside information, because it's illegal, right? It's against the law. You go to prison for that. You should do anyway. But who knows? Who knows? We'll find out later, I guess. Well, you missed your chance. Got to be quick, K. Roddy. Yeah. Bond Vigilante is saving the day again. Yeah, I buy that. I'm 23. Let's see. Oh, here's one from JLB. So super chat from JLB. They say, hi Roman, so am I too late to buy into this bounce? I think this whole attitude of trading around this is problematic, because I don't think you could trade it effectively. I don't think you could have chosen the bottom. But if you were going to buy equity anyway, carry on buying equity, I'd say. But could you put on a tactical trade to benefit from it? Maybe. You know, I think the snap upwards that we've seen already will probably carry on for a bit. But as I say, I think people are still worried that after 90 days we're going to go back to where we were. I think Trump would be crazy to do that, but who knows? And the unpredictability is what's going to keep markets not quite at the level they were at before, or significantly lower, depending on the probability of that outcome being priced into markets. But are you too late to buy into the bounce? Well, remember that the bounce will carry on for the next infinite number of years. That's the way to look at it. Markets will grow, on average, at 6% real forever. That's roughly what the equity market gives you. So are you too late to buy into that? No. You'll still be buying at a discount if you buy a global index, for the American part anyway, relative to where we were. So I'd say if you were going to buy anyway, carry on buying. Would you put a huge amount of risk on the table right now? I'd be cautious about that, because who knows? Who knows what the policy is going to be tomorrow? Just really difficult to judge. I say. Yeah, so Trob12 says, T-Rob12, I'm 23 and was given an early inheritance a few years ago, so I have quite a lot invested. Something that really surprised me is how many people sold because they couldn't stomach a worsening paper loss. Yeah, I mean, I just put out this video, which was very popular, I have to say, where I was saying, don't panic because markets have sold off. Don't sell after markets sell off. That's the worst thing you can do. So it's brilliant to see that a 23-year-old is so wise that you know that you're not supposed to sell if markets fall. Because it is a paper loss. Eventually markets are going to recover. And if you do sell, you'd have missed out on this huge upswing that we saw today. So that was that's the reason why you don't sell after a market fall, because you miss out on these big bounces. And if you look at black swan events, which are very large negative returns, they often go with golden swans, which are huge positive returns. And if you sell after a big black swan event, you miss out on the golden swan. So that's one of the reasons why you don't sell. Have you maxed out your stocks and shares ISA allowance for the year yet? Yes. What year are we now? Oh, no. So this is the other year. Okay, so I maxed out last year's just before. I haven't maxed out this year's because I haven't got the money. So, it's funny because I've just read this book, Die With Zero, which is an excellent book. I recommend it. And it talks about consuming while you're still able to. And they talk about things like, if you go to Italy, there are certain steps which are like really steep and long but beautiful. And if you want to do that, if you want to go and climb those steps in Rome, you'll only be able to do it up to a certain age. But if you're saving for when you're like 90, by that point it's too late. So the list of things you can enjoy your money on gets smaller and smaller as you get older. And I feel this myself. I probably I almost definitely couldn't do the things I could do when I was 20 now that I'm 55, 56. So I think that's a really good idea. And I was talking to Laura about this, and we were thinking maybe we should have a year of consumption rather than saving, because it's fun. We should enjoy life. Our business is doing well, and we should enjoy it while we can, I think. So I might not actually put in my stocks and shares allowance, ISA stocks and shares allowance this year. We might just spend it. And I've got to pay for Laura's birthday. It's a big birthday this year. So I've got to save up for that in the present. How are we doing? So we've got 12 minutes left. We have a super chat. Thank you from Scorched Earth Revenge. Good handle. In euros, interesting. I'm in the MSCI World Index, but it's 70% American. Yep, it is. Is that a question? Maybe there's more of a question below. Let's see if I can scoot through here and find it. It's really hard to scoot through these comments because the scroll bar is not very responsive. Sorry. See if I can find your super chat. But yeah, you're right. So if we look at the actual PDF. Ooh. Are we back? Yeah, sorry, we lost you. I'm in the MSCI World Index, but it's 70% American. Is there a question there? Yeah, I mean, if you buy a global index, it is going to be dominated by the US. So MSCI ACWI. Is it MSCI World that you've got? MSCI World, yeah. PDF. So if we look at the country composition, it is 70% American, 72% American. So yeah, US is 72, and it just dwarfs every other country. The next biggest is Japan, 5.4, UK 3.8, Canada 3.1, France 2.9. So yeah, I think you're going to have a huge slug of America if you buy a global index, no question. But that's not itself a problem. You know, the US is big for a reason. It's really good at growing earnings. If you look at the Magnificent Seven, they're just cash generating machines. They've been hugely successful, and they're likely to remain successful, I think. They've got huge margins. They're just very high quality companies. And in fact, the member video which I made today, which was about my market crash shopping list, quality is one of the things I really want to buy. But if you look at the MSCI quality PDF, so this is another MSCI index. You can see that it's even more dominated by the Magnificent Seven. I think my face is a bit small here. Make this a bit bigger. Yeah, so if you look at the weighting of Meta, for example, in this quality index, you can see that in this index, the quality index makes up 5.3 versus the parent index, which is MSCI World, I guess, where it makes up 1.9. So it's even more concentrated in things like Apple, Meta, Microsoft than its parent index. So you can see it's got an overweight in large caps, overweight in value, strangely, and an underweight in quality, which is surprising. So sorry, overweight in quality, underweight in smallness, because it's got these mega caps in it. I was reading it the wrong way. And underweight in value, because these are very expensive stocks even now after the sell-off. So yeah, if you tilt towards quality, you get even more concentration in the Mag 7. So they make up, well, this top 10 make up a third of this index, whereas they make up just a fifth, the top 10, for the MSCI World Index. So that's why quality was something I put off buying, because it was so expensive. But at least now it's kind of cheaper, and so I'd certainly consider buying it now that it's more reasonably priced. But anyway, that was one of the things I talked about in the explainer for members. That's one of the member benefits, by the way. Super chat from Chris3791, who says, China dumping goods to the world, consequences. Yeah, so I think what people are thinking right now is that if China can't dump its excess production into the US, it's going to be dumping it elsewhere. So what would that mean? We've got currently an MG car parked on our driveway. Well, actually, Laura's got it when she's driven somewhere for her spa getaway, when she's not tied down to doing these live streams. But that MG is a Chinese car. So if they're exporting that excess production elsewhere, what does it mean? It means that we'll get more goods from China, presumably at discounted prices, in order to shift them. Is that so damaging? Maybe, because our domestic car industry may be flooded by cheaper exports from China. But is that necessarily damaging? It's not great, potentially, but it does give us the ability to buy these things which would have been exported to the US, and they're probably going to be cheaper than they would have been. Is that going to cause a problem for other countries? Maybe. But, for example, the Eurozone has already been wary about this, about China dumping excess production into the Eurozone, and I think they've taken steps to try and avoid it. The UK, it's much more difficult to do, because we're more of an open economy, a smaller economy, than the Eurozone. So for us to push back would be much more difficult. And at the moment, after Brexit, we're desperately trying to create these trading relationships. So for countries like the UK, maybe it'll be a problem. We'll just have to see. And just see how long this tariff regime lasts. But of course, it's still in place for China because they did retaliate. JLB says, if I buy Europe ETFs, will I catch wave in the morning? Unlikely, I think. Maybe. I don't think you can buy it in the kind of after hours market in the UK. And if you're buying them in Europe, I'm not convinced it's going to work. Yeah, I mean, this kind of stuff where you try to do is stuff intraday to catch an upswing the next day, probably not worth it. Yeah, I doubt that's going to work. So what have we got? We've got 4 minutes, so I'll answer 2 more questions. Daniela Ashush says, would you max your ISA right now? I assume you mean, would I buy equity right now? I suppose I should consider increasing the drip feed. I mean, the reason why I was scared was because of all the tariffs, and the tariffs are now not so scary, and markets have rallied a bit, so I'm buying at a higher price. But should I accelerate it? I mean, I would have accelerated if markets had fallen further. Say the S&P had gone to, I don't know, a 16 times multiple, which is a really long-term average. That would have made me accelerate. But of course, prices have gone up now, and I think the volatility will continue. So I probably wouldn't go all in right now, no. I'll stick to my drip feed, I think, because I'm still scared about what's going to happen with the tariffs and what's going to happen to the prices. But I have maxed out my ISA for the previous tax year in terms of allowance. I used it. This year I probably won't, as I say, because Laura and I are going to have a year of consumption, probably. Redmond IY43, Redmond D43, says, buy Shell and BP. They tanked for some news in oil. Yeah, because oil prices, it was absolutely shocking how much they fell. Let's see if I can find. Yeah, there was some recovery. So this is the USO oil fund. So this tracks a basket of various energy futures. And you can see the effect since Liberation Day. A huge fall downwards. Let's get the percentages. So 7%, then 14%, then 15%, then it bottomed out at 22%, and now it's bounced back to minus 13%. So not a complete recovery by any means, but yeah, presumably you could kind of trade that by buying companies which are exposed to oil, or something like USO, which is exposed to the price of Brent or WTI futures. But you know, I don't generally do that. I mean, in my fund portfolio, sometimes I do that kind of thing, but not usually. Right, so one more question, and I can't see any more super chats which I haven't answered. So we'll go to one of your questions. Good point. Asian Invasion says, MG sell lower mid-market cars. UK sells more upper-end luxury SUVs. So hardly affects the UK. Good point, I guess. Gavin Lawrence says, Jaguar Land Rover had tons of government assistance to build crap cars at a loss. One more. Oh, here we go. So Paul Evans says, my wife and I have both turned 50. We have a modest 10k ISA investment in FTSE Global All Cap. Going forward, is there a safer investment such as bonds that we could also invest into? Well, I mean, a UK government bond fund, VGov, for example, from Vanguard, has a maturity, a duration of about 8 years. 8 years, I think, is the duration, which means you are exposed to these yield curve movements. And I think it's likely that the yield curve will stay volatile, which means that I probably go for shorter duration, maybe even almost zero duration with a money market fund. Now, money market fund hardly fluctuates in price at all if you go for an accumulation version of one. So I think that might, if it's safety that you want in this very volatile yield environment, then maybe going for really short duration would be the best thing. It's almost cash-like, but it gives a pretty good rate of return, whatever SONIA is, which is currently 4.45%. As the Bank of England cuts, you'll get a lower rate of return, but the price doesn't drop, it just stops growing so quickly as the rate of return decreases. So that's what I'd probably use for safety. Or buy a gilt, a single gilt, and hold it to maturity. Many platforms in the UK now have gilts. For example, what have I got? Yeah, so Interactive Investor has gilts, single UK gilts. Hargreaves Lansdown has it, although their trades are about 3 times as expensive as the one on Interactive Investor. And who else has it? AJ Bell, I think, has individual gilts, as does iWeb, a very low fee platform. So you can buy gilts on several platforms now, so maybe that's the best way. You can lock in a rate, and that way, even if the Bank of England cuts, you don't get affected for the life of the bond. So let's draw a line under it there. Don't forget, if you did want to watch or listen to our podcast, Many Happy Returns, about the crash, about the orange swan surviving the 10 trillion sell-off, and all of our sage guidance, which actually in retrospect looks pretty good because as usual we were saying don't do anything drastic. And please do like and subscribe, and also consider joining our community. You get access to lots of members only content. I mentioned the explainer I did today on my market crash shopping list. Plus you get to chat to me anytime you like on our chat application. And of course we've also now got an agreement with My Finance Future, which is an industrial strength cash flow planning app. You get a 40% discount if you're a member of our community, if you have the annual membership, annual premium membership, or the monthly membership with at least 3 months out of the last 12 where you've been an active member. So anyway, thank you all for joining us, and good luck with your portfolios. We'll just have to wait and see what the next day brings. Take it one day at a time.